Welcome, everybody, to the SNN.Network Canada virtual event. I'm your host, Robert Kraft. Thank you all for joining us today. And it is my distinct pleasure to introduce our next speaker here at our event. We got Ryan Irvine from Keystone Financial. He's the president and CEO. And his presentation today is titled Navigating Small Cap and Growth Stock Portfolio Building, Moonshots, Mistakes, and Recommendations. He even wore a suit for you. So, Ryan, with that, man, take it away.
I do like when you say distinct pleasure at the start. I always love that. So thank you very much.
Of course.
I'm going to start off today. I'm not going to give an intro of Keystone or anything that we do. Many of you out there already know what we do. We're just independent investors, and we provide advice, buy, sell, and hold reports to our clients across Canada and the US. Been doing it for 20 years. Fully independent, not paid by the companies that we recommend, only paid by our clients who are individual investors and institutional investors. So for this presentation, I'm going to start off by saying many investors, sophisticated and novice alike, make a simple but fundamental mistake when building the growth element of their stock portfolio. We would say they overcomplicate, and we're going to bring it down to small cap investing, which is one of the areas that Keystone does focus on. Now, often we see investors trying to be too clever by half, clever in a way that causes problems for their portfolio in terms of their long-term returns. Even for the best, the market is incredibly humbling. And by creating a simple set of guidelines to follow, maybe 2 to 3 primary areas, and sticking with those guidelines, you can become successful over the long term. Now, we believe that small cap investors are particularly susceptible to poor portfolio building habits, often taking too many risks or too many what we would call moonshots. They listen to very clever investors and presentations, maybe like this. They talk about in these presentations, you hear about AI, big data, genomics, psychedelics, 3D printing, blockchain, et cetera, et cetera. All of these things they tell you will change the world, and many of them may. But then an investor goes out and uses these themes to guide their investment strategies. The issue is often they eschew the fundamentals, buying into hype in the hope of hitting a moonshot that will change their portfolio over the long term. They buy concept stocks, saying, I know it is risky, but if everything works out and the company is applying blockchain and AI to their technology, which I heard is great from that presentation I heard, it must be good. This company must be good. Or they buy growth. They buy growth in what may be a great company. It could be a great SaaS business, for example, but they pay 100 times sales. It's often not a good strategy to pay those premiums, even in good businesses over the long term. From experience, I am here to say that you can get those type of moonshots by sticking with a very stringent criteria without undue risk that is often associated with small cap or growth stock investing. And I can give you some examples here. Now, I just kind of blew that one, but I'm going to give you an example. I'll ask Bobby or your audience, now you've already seen today, but what is the best performing stock in Canada? We're talking Canada today, over the past decade. Spoiler alert, I just showed you. Now, the best performing stock in Canada over the past decade is the Boyd Group. You can see here, this is a company that we recommended to clients around 12 years ago at $2.30. It's paid us over $5 in dividends. It trades at $225 plus today. But Boyd is the type of moonshot that you can get in your portfolio, the type of moonshot returns without the hype. Could not be a more boring business. What do? They consolidate auto repair shops. But the returns quite literally could not have been better over that period. It has been the best stock to own in the country over the past 12 years. It was trading at 5 times earnings when we recommended it, and it was growing. So that's an example of that moonshot type return that many small cap investors are looking for without the risk. Now, another example, how about one of the best performing stocks over the last 3 years in Canada? Now, this company is now graduated to the NASDAQ from the Canadian Venture Exchange. Of course, it is Expel Inc., symbol XPEL, simple, on the NASDAQ today. Trades at $52. Just over 3 years ago in 2017, the stock traded at $142. Great growth potential. good solid balance sheet, good solid earnings. I think we bought it then at around 10 times normalized earnings. Once again, a very basic and boring business that has produced absolutely portfolio changing returns over the past 3 to 4 years without hype, without being in the hottest sector, just by going about its business, producing excellent growth and we purchased it at a reasonable price, which is key. Good business, but purchased at a reasonable price. Now, the key is to find more small cap businesses like this and add them to your portfolio. Sounds very simple, doesn't it? But also it's to avoid the pitfalls in investing in small caps. But how do you do this? How do we do it? Well, we have no lives. So we look at CEDAR, where it's the System for Electronic Document Analysis and Retrieval in Canada. All public companies have to file all their quarterly statements on their annual MD&As and the like. Our analysts quite literally manually screen the financial statements of all 3,500 plus publicly listed companies in Canada and over 3,000 in the US twice a year, and read through the MD&A of those and make our criteria. The ones we read through the MD&A of the companies that meet our criteria in terms of revenue growth and reasonable balance sheets and profitability. Now, I think that there's 3 simple questions that you can ask yourself. Sorry, I went through that. 3 simple questions that you can ask yourself. Number 1 would be, how many stocks do I want to own in my portfolio? This is about composing that portfolio. Small cap or growth stocks are an element of that portfolio, but you should look at your overall portfolio as well. What types of stocks should I own? And we'll give you a profile. I'll give you a profile today of this type of stocks we believe you should own in your portfolio. And over what period should I build that portfolio? Now let's look at that first. How many stocks should I own? You heard diversification all the time. It makes sense to a point. Generally, if you're building a portfolio, if it's in the small cap area or your overall portfolio, don't own 2 to 3 stocks. Even if you or we have put in all the research into the world, this is too much company specific risk. An extreme example of this would be if you were to hold Tesla. It's considered a CEO driven company. If its CEO, Elon Musk, heaven forbid, were to pass away, that would likely have a dramatic negative effect on the stock. You can mitigate this company specific, you cannot mitigate this company specific risk away if Tesla is one of 2 or 3 stocks you own. If it is one of 20, you can handle it. It can help allay that company specific risk. On the flip side, we see portfolios, even in the small cap arena, some investors out there, very avid investors, owning 50 to 100 plus stocks. All you've done is created a complex, fee-heavy portfolio that mirrors the market. That is what we like to call, and wait for this, it's really funny, diversification. It's about as funny as it gets in finance, so laugh it up right now. But don't just take our word for it. We follow Warren Buffett's teachings. He says diversification is protection against ignorance. It makes little sense if you know what you're doing. And we believe in that. I'll give you another quote. Bill Gross, who co-founded PIMCO and managed one of the largest funds in the world for decades. He said, do you like a particular stock? Put 10% or so of your portfolio on it. Make the idea count. Good investment ideas should not be diversified away into meaningless oblivion. We believe that. Even if you do all the research in the world, if you have 100 stocks in your portfolio and you get that one company that goes up 100% in a year, that's great. You found that one company that did tremendously well. It only makes 1% difference in your portfolio. If it's 10% of your portfolio and you get a return like that, or even 5%, it can make a meaningful difference over the long term. So if you like that particular stock, make it a meaningful part of your portfolio. Now, what type of stocks do you want to own? Let's look at the profile of small cap stocks or companies that matter. Most companies will not check off all the boxes. I'm going to go through 10 criteria here. But if the more stocks you can add to your portfolio that check off 7, 8, or 9 of these elements, the better your path will be in terms of profitability in your portfolio over the long term. So let's look at the profile, our profile of a great small cap. Start with the balance sheet. Do not look at debt-heavy companies. Look at companies, particularly in this area, with strong balance sheets. Often we look at companies with net cash positions. Positive cash flow. That would be a minimum criteria. Positive cash flow from operations shows that the company can sell its product or services and grow its business over the long term without continually having to go to the market to issue shares. Reasonable growth path. So going forward, does the company have that reasonable growth path ahead of it? We look for attractive valuations. It doesn't always have to be the cheapest company on the street, but reasonable valuations relative to its growth path going forward. Even in the small cap segment, we look for potential of a dividend or dividend increases over the long term. Companies that grow their dividend or dividend growth stocks just produce some of the best returns over the long term. Now we look for, and you can't forget about this, obviously, the management team. You've heard these things many times, but it's good to beat you over the head with it. Solid management team, significant share ownership in the business. If you can get it, they're pulling on the same rope as you. It's a great way to invest in a company. Businesses we can understand. As I said, we go through, just in Canada alone, 3,500 companies on an annual basis. If the business is too complex, and we do this for a living, then we will move to another business. Because even if it looks so tantalizing, we think it's great value, but we can't understand what the business is doing, then we can move to another company. Operations in relatively safe jurisdictions. There are certain areas of the world that if a company is domiciled, not necessarily doing part of its business in that area of the world, but if it's domiciled or is incorporated in that area, that we just don't touch. Positive industry or niche outlook or sentiment. Now, sentiment is important. I can touch on that. Many people ignore the sentiment in an attempt to find value, particularly in the small cap sector. I'll give you an example of that. Coal companies. Now, we just did that sweep of 3,500 companies in Canada. Now, there are a couple of small cap coal producers in our research that screened out and can be bought for 1.5, 2 times cash flow. That would appear very cheap. As a value investor, you may be seduced into jumping into a business like that. But if investors really want nothing to do with funding what they would call dirty energy, with countries around the globe moving to clean energy, for example, they can perpetually be on sale. They're classic value traps. Now, the Canadian markets are awash with oil and gas stocks, energy companies. A segment we have avoided for almost a decade now, and that's allowed us to outperform the general Canadian market. While some assets now, right now in this sector, appear to be on sale, we fear the potential for the segment to follow the cigarette or coal stocks in the perpetually on sale penalty box over the long term. So what I'm saying is you need to be aware of the market sentiment, particularly in the area of long-term trends. Finally, we'd look at a strong track record, just a track record of growth from management. Do they hit their targets is one thing that we look at. So if they're guiding towards 5 cents per share in the next quarter and they hit 5 cents or exceed it and hit 6 cents per share, that should check off a box. Now, this is something you can really only look at. I mean, you can look back at their track record over time, listen to their conference calls, but you can really gain appreciation for this over time the longer you own a business. Now, the third question we're going to look at is over what period should I buy my portfolio? This is simple. Many of you know it, but do not practice it and end up trying to time your perfect entrance to the market. What we would suggest is buying 10 or 15 to 25 stocks. That's the sweet spot, gradually over a 12 to 24 month period. For aggressive investors, if you want that small cap element to your portfolio, 8 to 12 within that overall portfolio in this segment. What that will do, if you build it over time and don't crystallize your entry point at one point in the market, it reduces risk to short-term market corrections. This is a strategy we've employed for decades, and the advantages of it were seen in the crisis earlier this year. At the start of the year, for example, many of our clients who joined 3 and 6 months or a year prior had only partially built their portfolio or gone partially through the process. And then they were able to buy a number of recommendations following the drop in the markets on sale relative to they were just a month ago, where they were just a month ago. What this offers you is flexibility to add to new positions as new opportunities come available. What is the process though? If you started building that small cap area of your portfolio or of your overall portfolio today, we would start with say 3 to 5, even 2 to 4 initial positions. Add 2 to 3 new stocks each quarter, every 3 months as new information and research is released. You can layer into some positions. Start with an underweighted position in an individual stock and add gradually over time. I'd like to look at some common mistakes in the small cap arena and generally building your portfolio. Many people just act like a trader. For the average investor out there, even for the pros, if you look at your portfolio statement every month and see hundreds of trades, this is too much movement in many cases. Even 50 plus trades for the average investor can be symptomatic of something wrong with your portfolio. Either you're buying the wrong stocks or you do not have a realistic time horizon or holding period in your mind. We did webinars recently. We put together an entire segment on day trading and used empirical studies. The findings from the most recent study, I'm going to quote from it directly here. It is virtually impossible for individuals to day trade for a living. This study found that 97% of all individuals who day traded for more than 300 days lost money. Those are not good odds. As an investor, stocks you buy should be with the goal of holding for 2 to 5 years, or really as long as possible as the business continues to perform. Some of our best stock recommendations over the long term have been held in our portfolio for 10 plus years, and we continue to hold them today. These would include a company we talked about earlier, Boyd Group, which is one of the best performing stocks in Canada. It is the best performing stock over the past 12 years. Enghouse is the 4th best performing stock that we've held for 10 plus years now. They're a great unknown software acquirer and just a company that is cash rich and acquires out of cash. They've bought 25 businesses over the last 10 years. We continue to see that growth for that business today. But you want to hold that company as long as it continues to perform and trades at relatively reasonable valuations. Now, I think you need to take research seriously in your portfolio overall. If you're looking into stocks or investments you want to own, if you're getting help from an analyst or you're doing it yourself, give the research the attention that it requires. Remember, in most cases, big bank advisors, particularly in Canada, are basically jack of all trade financial service salespeople. They sell you home insurance, estate planning, get you a mortgage, car insurance, etc. They are not specialists in researching stocks because often 50 to 80% of your portfolio are composed of equities. They are the most important element of your financial future. You should have specialists in this area. If it is you or a research team that you trust, it's important to understand that buying stocks is actually means, and you know this, but it's good to be hit over the head with it. You become a part owner of a real working business. Don't forget that. It's a significant purchase like a car or a home, and you should research it before you plunk down your money. Find out whether the company has a growth path ahead of it, like we talked about those 10 rules. It's in good financial shape, whether the management team is strong, and look into the valuations, cash flow, or have someone do it for you to judge whether the company is trading at above, below, or at its fair value. The key is to give this research into the stocks that you own the attention that it deserves. If you're going to build that portfolio, another common mistake is people don't commit to the process. Now, if you're serious about building a portfolio, you have to commit to it. Now, contrary to what people think, this does not mean that you need to watch the markets on a daily basis. Unless you absolutely love it and brings you particular joy, then fine, do it. But watching the talking heads on one of the daily financial networks can actually be a negative for your portfolio and often for your mental well-being. In fact, we advise against it. You will sleep easier at night if you just own good quality businesses. What I mean is, when I say see the process through, if you buy your first 2 to 4 stocks in the first month of building a portfolio or becoming a client to our services, and the stocks go down or the market corrects, it is not then time to quit. You keep buying great businesses over a prescribed 12 to 24 month period. Build that portfolio strategically over time. Commit it and see it through. And evaluate that plan that you have for buying those individual businesses in years, not days or months, and stick to it. Now, one thing we see in the Canadian market too, small cap, large portfolios overall, but Canadians lack exposure to the US markets. If you look at, this is a composition of the Canadian markets here. what you see is 50% plus resource and financials. So that is one of the reasons our markets in Canada continue to outperform the US markets. Key areas we underperform are in technology. If you can look here, 5%, just 5% of the Canadian market is technology. I'll give you an example of why this can harm your portfolio. Over the last couple of years, 3 to 5 years really, but one of the areas that we've wanted our clients to have exposure to is cybersecurity. When we did a sweep of the Canadian markets, there's basically 5 companies that you could find that are public in this segment, and none met our initial criteria. In the US, when we dig in, there's 60 plus companies. We were able to dig into research here and recommend a great company a couple of years back named Fortinet, which is one of the biggest now cybersecurity businesses in the US. But if, this is the juxtaposition here, the US market, you can see almost 20% of the market is in technology. So if we want to get exposure to great themes or trends over the long term, AI, the Internet of Things, many of these things that we continue to see great long-term growth paths for, we need exposure to the US market. Many Canadians are critically underexposed to this market. That's why you need to have some investments in the US, or at least some Canadian companies that are listed on a Canadian exchange doing business at least down in the US. Another common misconception is that cash is your enemy. There's this investment fallacy out there or misconception that you have to be fully invested at all times. It does not have to be the case. In fact, in uncertain times, holding cash is often a good option. And we would not want to deploy cash just for the sake of being fully invested. Now, when we say cash is king in your portfolio and not the enemy, it's two-pronged in meaning. Now, keep some cash on the sidelines, ready for opportunities. This year, obviously, they have, and they will continue to present themselves going into 2021. But also look for cash-rich businesses with a history of profitability. These businesses can survive downturns. They have that cash buffer. They can take advantage of strong balance sheets to make opportune acquisitions and allow them to thrive coming out on the other side when the recovery begins, and it always does. Now, I'll give you an example of this. Enghouse, I briefly spoke about this business back in 2006, 2007. This company had around 100 million in net cash on the balance sheet. Analysts were then screaming for them to deploy that cash. Now, prices in the businesses they were looking to buy were too high. Management refused to do so, and that angered many investments. You saw some sells on the street. Now, it was definitely the right choice at the time. The stock then traded at $4 and had a great cash position, like we said. In the ensuing years, following the 2008, 2009 market crash, Enghouse went on to buy from cash 20 plus businesses, and it continues to do so today. So over that 10-year period, what did the stock do? It went on to be the 4th best performing stock in Canada. Now, today it trades in the $60 range, an excellent return over the long term with a patient, cash-rich business. It's good to have cash in your portfolio, good to have cash in the businesses that you own. Finally, we'll look at a common mistake here. It is, you don't have to buy your full position in one stock at one time. This is particularly acute in the small cap area of the market, where you can see an event coming up that may lead to an impetus to drive the stock forward. You can learn to layer into some quality businesses over the long time. It's perfectly normal to first identify that quality business that you want to own, then buy it in pieces. I'll give you a specific example of this. If you can often split your portfolio purchases up into 2 to 4 tranches in that one company. Let's give you an example now. So if you had 200,000, relatively small amount to invest, designed to purchase an equal dollar amount in 20 stocks, so 10,000 in each, the initial 25% position in the stock would be $2,500. If you blend those purchases over time at lower prices, they guard against buying too early and too late in individual companies. Now that'll finish off the common mistakes part of this segment. So let's take a look at some recommendations. Now, in our growth or small cap universe, we typically break our recommendations down into 2 portfolios. Our core positions, which we call our focus buys, they constitute long-term portfolio positions for clients. Typically, the stocks in this grouping profile with reasonable to attractive long-term valuations, strong long-term growth path, proven management, and strong balance sheets. Examples of these type of companies in our Canadian market include the Boyd Group, we talked about it, Enghouse Systems, and Expel. Now, we also have emerging what we'd call growth positions with Compose, our small cap discovery portfolio. This portfolio is for aggressive investors who do not mind taking higher levels of risk for potential higher gains over the long term. The focus is on high growth, emerging growth, and turnaround businesses. While the stocks included in this portfolio have track records, may not have the track records that we look at in our focus buy portfolio, we're trying to buy early before they hit the radar of larger investors. Now, let's look at the first company. It's Protech Medical Corp, symbol PTQ on the TSX Venture Exchange. Symbol is PTQ, like I said, Venture, about $1.60. Doesn't have a yield, but it is growing its business over the long term, which is what we like. About $181 million market cap. So truly a small cap in the Canadian market. It's important to always look at what the business does. Many people buy a symbol, PTQ, and move on. What we like to do is actually examine what a business does, and of course you should too. It provides in-home monitoring disease management services, including end-to-end respiratory solutions for patients in the United States healthcare, US healthcare market. Now, why do we like the US healthcare system? Or why not like the system, but why do we like investing in this area of the market, home healthcare? Well, the US healthcare system has, and I love this stat, 11,000 new people qualifying for Medicare every day for the next 19 years, which is forcing this market to find and embrace cost-effective value-based healthcare solutions. Protech is a company in that segment that offers that. Viamed is a company that we've recommended 3 years ago that is in this market as well, specifically the vent area of this market that we like. Protech, we believe, trades at a discount, and we'll go over that now. Why do we like it? Strong balance sheet in the business. Definitely a strong balance sheet. Last quarter revenue growth of 28%, adjusted EBITDA growth of 47%. We think it has reasonable valuations relative to its peers. So it trades at a discount to peers, which is what we like to see. Now, valuations, fundamentals, EV to EBITDA is about 6.5 times 2021 adjusted EBITDA. So its peers are around 12 times. So roughly half that. We like to buy good businesses at a discount to their peers. Our fair value estimate is around $2.15 based on an EV to EBITDA multiple of 8.5 times. If they continue to execute on their growth by acquisition strategy, that could be ratcheted up over time. And we've already done that. This company we've owned for just over a year, back to when it traded around 78 cents. So it's had a good run from that level, but we think trading at a discount to peers, it offers growth at a reasonable price. This is a business that we just bought at this time last year, TruLieve Cannabis Corp, symbol TRUL. It's on the CSE in Canada. It's $41.40. It was trading at $16 at this time last year. It's had a tremendous run. Doesn't pay a yield. Market cap of $3.62 billion. What does the company do? Again, important. Vertically integrated seed to sale company. It's the largest, first and largest fully licensed medical cannabis company in the state of Florida. Dominates the market, over 50% market share right now. Cultivates and produces all of its products in-house and distributes those products to TruLieve branded dispensaries in the state of Florida, as well as directly to patients via some home delivery. Growth potential. TruLieve also operates in California, Massachusetts, and Connecticut, just completing significant acquisition as well. Why do we like it? Well, it has a strong balance sheet, $193 million in the bank, reasonable debt levels in an area of segment of the market, particularly in the US, that has been hard to fund. This company has funded it on a reasonable basis, this growth business. Now, strong track record of organic revenue growth and EBITDA growth. Again, we said it's dominant in medical market in Florida via a large recreational market share long-term. We like it long-term there. Reasonable valuations, but it is higher risk. Let's look at those valuations. Despite the tremendous jump that we've seen this year in the share price, it's 16.6 times EV to EBITDA right now. And the guidance for this year's end, it's about 15.1 times. Our fair value estimate is about 45.50 based on a justified EV to EBITDA multiple of 16.5. We believe that multiple, as they continue to deliver on their stated earnings targets over the long term, can be ratcheted up over time, but there is a high level of growth here, and we like the business over the long term for aggressive investors. The next company we're going to look at is a relatively unknown software business in Canada, Sylogist, symbol SYZ on the TSX. It's on the Venture, I believe. 11.90. It pays a dividend, this company. Smaller cap company. It pays a 3.9, almost 4% dividend. Market cap around 282 million. What does the company do? Well, they provide comprehensive mission critical enterprise or ERP software solutions, including fund accounting, grant management, payroll, public service organizations, public sector, nonprofit organizations. Now, why do we like this business? Valuations are the primary reason, but we see a transition to a subscription and maintenance or SaaS type sales model, higher recurring revenues. There's a new CEO that has come in with a new growth path going forward. It's a strong balance sheet here, 180 or $1.80 per share in cash in the bank, over 40 million in cash, 42.8 to be exact right now. Good track record of revenue growth, EBITDA growth, and dividend growth payments. It's made a recent acquisition, a small kind of tuck-in acquisition, 5.5 million, but growth has returned in 2020 to the EBITDA. We see low valuations relative to peers, another thing we like. And let's look at those valuations right now. This year, around our trailing basis, 88 cents in EBITDA. So current valuation about 11.4 times adjusted earnings, significant discount to peers. Fair value estimate right now would be around 14.50 based on a justified price to adjusted earnings multiple of 15, adding back that $1.80 in cash. Now, if this company can start growing again, as we've seen, as we expect it to do with a growth by acquisition strategy, it should receive well above 15 times earnings, adjusted earnings. Now, it's also doubled its dividend over the last 5 years, and we like companies that responsibly give back money to shareholders. Now, this is a higher risk company, Jerash on the NASDAQ, trades at $5.96. We just picked up coverage on it in the past year, trading around in the $4.50 range. It's now around $5.96. It pays a good solid dividend, 3.35%, $62 million market cap, so almost a nano cap in the US market. What does the business do? Well, it's based in Jordan. It manufactures well-known four well-known brands, private label type brands, Costco, Walmart, VF Corporation. Its main business has been for the North Face brand, if you're familiar with that brand. Now, low-cost manufacturer operates in EU and US free trade zone in Jordan. High geopolitical risk, but we do see a positive tailwind from the company in that during the COVID-19 crisis, the lockdown, there was some supply chain issues coming out of China. Now, Jerash is a safer zone, and it is and there are companies considering moving some of their production to this area. We see that as a positive over the long term. The highlights here: a good solid earnings on this company, despite what has been obviously a down year for retail clothing manufacturers in general. There is a very strong balance sheet here. We said the market cap is 62.5 million. There's around 27 million in cash in the bank. Strong working capital. Trades at around 11 times earnings. Low valuation is because of the geopolitical risk, but we think it will start to grow next year once again. Right now, we'd hold, collect the dividend, and await for the recovery in retail over the long term. Now, generally, I hate gold-related companies, particularly the producers in Canada, especially the juniors. They've been typically terrible performers over the long term. There are some of the streaming companies and royalties that we like. that have actually produced good, solid cash flow over the long term. This is one way to play the gold segment. It's a little different. We'll tell you why. DNG on the TSX, $1.79, pays a solid yield, perhaps the largest yield in any gold-related company. 68 million, so truly a small cap company, almost a nanotech in the Canadian market. What do? They're based in Peru. They are involved in milling, not mining of gold, primarily through government approved ore processing operations. Again, we said they mill, not mine. So they have, in normalized times, over 400 individual artisanal or small scale miners that bring them feedstock. They process it and then sell the gold. Essentially, that's how it works. Sorry, my voice is going on the side here. Highlights. Now, they've had 9 consecutive years of profitability. Trailing 12 months cash flow is 19 cents per share. There was some near-term uncertainty. They've come back online in Peru. We believe they'd opened up for mining in August. It really ended up being full up to capacity at the end of September. Strong balance sheet, 16.6 million in cash, net cash. And like I said, the market cap is under 70 million. So a good percentage of this market cap is in cash. Low valuations, normalized basis, about 4.5 times cash flow with the cash removed, which is a low valuation. The final company we'll look at today is also out of Peru. This is a company we've had in coverage for just over a year since it traded around in the $11 range. It's moved up smartly of late. It's in a segment of the market that we like over the long term. Polaris Infrastructure, PIF, 1775. Good, strong yield on this business, 4.3%, just under $300 million market cap. So they are a renewable power producer in Latin America. Nicaragua is their primary asset, also into Peru and moving into Panama as we speak. They have a deal to move into a run-of-river power operation there. Assets is the San Jacinto 72 megawatt geothermal power facility located in Nicaragua. Like we talked about, they got 3 run-of-river hydro assets, about 32 megawatts in Peru, 5 development stage projects as well. Why do we like the business? Strong cash flow, growing cash flow and diversification over the long term, reasonable debt leverage, and attractive valuations. The key risks here are the country risk in Nicaragua and the Peru lockdown that we saw there. But the companies continue to produce. It's essential power that they're producing, geothermal power from Nicaragua and run-of-river power. So we're talking about a renewable energy company that trades at a significant discount to its peers, and we like that. Let's look at that discount. Cash flow over the past 12 months, roughly 274 US. That's about 5 times current. It trades at about 5 times current cash flow. Sorry, let's pull that back for a sec. And the healthy balance sheet, like we talked about, dividend payout ratio around 25%, which is good to see. Outlook, higher risk company due to the concentration in Nicaragua. Contracted cash flows should not be impacted and have not been impacted really during COVID. Executing on a strategy of geo-diversification that we like to see throughout Latin America. As we see this over time, we think that the valuation multiple on the stock will uptick, and we expect to see growth over the long term. That strong balance sheet supports the growth. Attractive valuations relative to cash flow as well, like we said. And finally, there's the disclosures. So any of the companies that we own or any of our analysts own are disclosed right there. And I'd like to thank all of you, and I wish you all profitable investing in 2021.
So look, I had a couple questions that were submitted from Twitter that I thought would be really fun to answer real quick here.
Excellent.
So Dean Tratier, our another speaker actually at this event, had a couple good questions for you. So
picking my brain, That's awesome.
Oh yeah, let's go. So here he said, do you find it harder to find new ideas today versus 5 years ago?
Yeah, it's a good question. We always find it hard to find companies that fit our criteria, but there are variations on that. Like to give you an example, 2008, 2009, after the crisis, we were like a kid in a candy store. In a typical year, we might find 6 or 8 companies that meet our criteria. In the first 4 months after that, we found 15 to 20 companies that we recommended. So it was a great time. Right now, we do find it harder. If you're trying to marry value and growth, there's usually a significant wart on the business that we're seeing. So you don't always see that. Like it's very hard to find an Expel where we love the business, we love the management team, the balance sheet looks good, we think it's a hit, there's hidden profitability in the business, and you can see like a 3 to 5 year definite growth path ahead of them. That's difficult to find. Having said that, you could still find some individual anomalies out there, and like Polaris is a company that, I wish I was on the show or doing this a couple months ago, because it was trading significantly lower. There's a couple companies that I talked about today that they're in that boat, like Trulieve, that, whether it's because investors swore off cannabis stocks at one point, a year ago, year and a half ago, you can find that value in the actual companies. Like we looked at every company in the cannabis sector. In Canada, there was 210. And we did a report prior to legalization in Canada. We looked at all 210 and we made 0 recommendations until Trulieve, which is actually operating in Canada or operating in the US, but listed in Canada, was profitable and had a small track record of growth. And that was a business when investors had said, oh, I don't want to be involved in cannabis, that was the time to invest in it. So a very long-winded answer, but I'm saying it is more difficult now. But you always find these little anomalies. And we were talking around the office yesterday how when you look back at, the previous decade, you always do this at the start of a year, although we're 1 year into this decade, I'm going to try to forget the year we just had, relatively speaking. But when you look you look back at like the Boyds, the Enghouse, the Expels, like when we do that sweep through 3,500 companies, there will be 1 or 2 companies in there that are, over the next decade, the company that does that. So it's freaking exciting to look through, even though it's boring as all hell, to look through that many companies. But that's what drives you. I can find a company that's going to go up 1,000, 2,000, 3,000% over the next decade. So whether it's more difficult now, yes. But what excites me is I know that, one of these companies that we're looking at right now and tearing through the MD&A will be one of those companies that has that potential over the next 10 years. It still excites me.
All right. Now, final question is from Dean, actually asked this one too, does it seem like management teams are better or worse at having public market presence?
Yeah, there is, I would take it such on a case-by-case basis. I think companies are better. Like some are doing more, like online conferences, which is nice to see, and nice to see them doing conference calls. Like we cover large cap businesses too, as well, where you get all of that, right? But on the smaller side of the business, there is still the anomalies, like SYZ that I talked about today. Like they could do themselves a massive favor by getting out, and they've said now they may get out to the market and talk a little more. Like that is one of the reasons you get, a software business trading at 15 times with a net cash position, because they're not talking to the market as much. So if you want to look granularly at that individual situation, there's a company that you want to wring their necks because they could get out there. And if you want to grow by acquisition, why not talk to the market? And then you're going to get a higher valuation. It helps your story over the long term. Then there's some good businesses that seem to get it and are out there. Yeah, I think it's easier to do calls like this now. So we are seeing a little bit more of that, and there's more people kind of bringing their phone lines. So, it's a lot easier to do a quarterly conference call than it is to talk individually to 100 analysts. So we do see more people trying to do that, but there are still some individual situations where it's like pulling teeth to get management to talk to the market where they should. I would like everybody to. It's usually pretty easy for us to get a hold of someone, but they should talk to, anybody through a conference call every quarter. I would advise every company to do that.
Through events,
Yes, yeah, through events. Like I'm not through events like this. All the companies should definitely go to any event that Bobby puts on, right?
No,
that's what I'm saying. Not prompted at all. No.
There was no prompting.
It's true though. They should do. We say get out to these events. Like you never know who you're we don't always do these events, but you know what? Like when in person or online, we meet people, we find new companies, you know, and yeah, it's the more you stick your head out there, the more, like I will never, if somebody, there's a ton of IR companies that come to us and pitch us individual companies. 90% of them are absolute garbage, but I will listen for the first minute. And it, you know, if there's something that I don't know about the business, typically I already know it if it's in Canada, but I will listen to the first minute. And then if it's just, you know, but I'll always listen because, you know, if there's something there that I've missed in the business, please tell me.
That's very nice of you. So, so
it's
right.
just, it's for our clients. It's, you know, honestly, and that's it. Like, or for myself personally, sometimes you find these anomalies, right? And that's what, I mean, like I said, that's what excites me. If I can find one company this year that doubles or triples over the next few years, like we've done a tremendous service for our clients, and it can make up for a lot of mistakes because we make mistakes. Every investor makes mistakes. Any investor that tells you they don't make mistakes, you know, run out of the room.
For sure. All right. Before I let you go, one quick disclosure. Do you still, are you still a shareholder in Boyd Group or Expel?
Both. Yes.
Both. Very good. All right, Ryan, where can our audience go and find more information about you, Keystone Financial, follow you on Twitter?
Yeah, they can follow us on Twitter. I should probably tweet more. I think it's Ryan or Irvine75. I don't even know my handle. It's terrible, but just go to www.keystocks.com. You kids and your Twitter. Actually, that really dates me because I don't think there's anybody under 40 on Twitter anymore. Is there? I'm not sure. I'm kidding. There's lots of
It's at Ryan. It's at Ryan Irvine. Is it Irvine? I always call you Irvine. You said Irvine.
It's Irvine. You've got it right. Yeah, but it looks like Irvine. If I say Irvine, then they say, "What the hell? You're not there." But there's an E on the end.
Yeah, like right. Yeah. So it's I blame
my parents.
It's at Ryan Irvine with an E as 75. So you can go and follow Ryan there and at Keystocks, I believe.
Yeah, at Keystocks, and just go to www.keystocks.com, and we're happy to answer your questions and help you build a large portfolio, small cap portfolio, whatever you're looking for. It's all about the research for us, really.
Very cool. All right, Ryan. Well, thank you so much for taking the time to do this today. Good luck. Stay safe. I look forward to our next chat, man.
You too. Great to see you. Have a great day. Thank you.